Good afternoon and welcome to Re-engage and Trade, Foreign Exchange and the Future of Globalization. My name is Stella Sheehan and I am the Deputy Director at the World Trade Center St. Louis. I want to thank you all for joining us today for what promises to be both an engaging and an informative session. We had the pleasure of hosting today's speaker back in January in our offices for an in-person event, and he certainly did not disappoint. So just a few housekeeping rules before we begin. You will be muted for the duration of the presentation. If you wish to ask any questions, please do so via the Q&A on the bottom, towards the middle of your screen. You will see Q&A there, and if you wish to pose any questions, please do so via that platform, and we will attempt to get to those questions following the formal presentation. It's now my great pleasure to introduce our first speaker, Mr. Tim Nowak. Tim is our Executive Director here at the World Trade Center, a position he has held for over 12 years. Prior to his current role, he worked in international markets in Africa, Asia Pacific, Europe, the Middle East, South America, and in fact spent some time again in Asia Pacific during his 2014 Eisenhower Fellowship. And like all good St. Louisans, self-respecting St. Louisans, he is a die-hard Cardinals fan. So with that, I will pass the baton to Tim.
Thanks, Stella. And I couldn't help but notice Marc's smile at that point, introducing me, because I was going to leave this out, Marc, but Marc's originally from Chicago, and according to his bio, a lifelong Cubs fan. How nice. But Marc currently lives in New York City and has been covering the global capital markets for more than 30 years, including stints as the global head of currency strategy for both HSBC and Brown Brothers Harriman. Marc joined Bannockburn Global Forex as Managing Director and Chief Market Strategist in 2018. He's a prolific writer and speaker, and he regularly appears in the financial media, including the Financial Times, the Wall Street Journal, Barron's, Bloomberg, the Washington Post, among many others. In fact, you've also probably seen him at some point on one or more of the financial news channels, including CNBC or Bloomberg TV, CNN, or Fox Business. Marc's first book, Making Sense of the Dollar, was published by Bloomberg Press in 2009 and received a Bronze Award from independent publishers. The second book, The Political Economy of Tomorrow, was published in 2017. He is an honorary fellow of the Foreign Policy Association and has been named a business visionary by Forbes. When I asked Marc about how he would like for me to introduce him, one of the comments that he said here just recently was, Tim, I like to think that I'm no longer a part of the problem. I'm more a part of the solution. And he was just mentioning that he spent so much of his career working with S&P 500 firms that he's now really focused on small to medium-sized companies, and what a rewarding transition in his career that has been. So aside from the whole Cubs thing, Marc, we're honored to have you again here, this time virtually, and look forward to your comments. Thanks so much.
Great. Well, thank you. Thank you very much, Tim, and especially to Stella and Bamey for helping set this up for us. You know, we have a local partner at Bannockburn in the St. Louis area, Chris Haynes, who I'm sure is listening in on this as well. And I really do, Bannockburn, we do a lot of work with the different world trade centers, and I really do believe in that your mission was always important, and I think in this environment, it even becomes more critical. And that's really what I'd like to talk about this afternoon. So thank you for spending part of your afternoon with us. And what I'd like to do is just give you about a short, quick overview of where we are now, given this big economic hit we've taken, and talk a little about the foreign exchange market, what can be expected, and then really conclude the formal presentation with just some ideas about where we're headed, where we are in the big picture. And perhaps what is most challenging about this time is just the high degree of uncertainty that there is. And it reminds me of this story about the 5 blind men who are walking in a jungle and they stumble on an elephant. But they don't know it's an elephant because they're blind. And so one person feels the air and says it's a leaf. Another one feels the tail and thinks it's a snake. Another one feels a leg and thinks it's a tree. And I think that this sort of illustrates this high degree of uncertainty. And so if we could just show the first slide, I think this really illustrates the point. So on this map from the New York Times, the red area that you see, those little specks of red, account for half of all the COVID cases in the United States. The blue counts for the other half. And this is what I think is very important, is that where we are sitting, what our experience is, influences our perceptions, and then it influences like our assessment of what's going on. And the same thing with this next slide. While this first slide showed you the incidences of the virus, this one shows you the fatalities. And again, the yellow specks account for 50% of what the US has experienced. And the green would account for the other 50%. So again, you can see how why people maybe in those pockets have a different perception of what's going on. And so what I'd like to do in these few minutes here is really just share with you the part of the elephant that I'm feeling. And the first thing I think to maybe could you give us the next slide is to just illustrate the kind of economic hit. This was the OECD. This is the Organization of Economic and Cooperation Development. It's about roughly 26 countries, high-income countries, and this is their latest forecast that came out in the middle of the week. And this will be part of the overall the PowerPoint presentation, so they'll be made available to you after this presentation for your own purposes. But you can see how in the United States, so there's two scenarios here actually. The top one assumes that we're going to get another wave of the COVID virus. So it's a more pessimistic view. And the bottom one gives you the current, sort of we get hit once and slowly recover from that. And that is really, I think that lower one is really the baseline that most people are going off of. And by most people, I mean investors, money managers, businesses, large businesses. And what's happening, I think, is that while we could see, as we're seeing right now, some states that opened up early are beginning to see some uptick in the cases. And this is especially, say, in Texas and in Arizona. But it doesn't seem like it's going to lead to a nationwide lockdown. It might reinforce or bring back some local stay-at-home orders, local lockdowns, but I don't think we'll see another like countrywide one. And part of that map really illustrates the divergence of people's experiences. I think what's interesting to note here, if you look at on the bottom chart, the sort of the hit that they say the U.S. is going to have, and they say the U.S. economy is going to contract by 7.3% this year. And what's ironic about it, I think, or what's striking, is that the Federal Reserve came out with their forecasts the same day, just later in the day. And the Federal Reserve, despite promising to keep interest rates so low until at least 2023, that the Federal Reserve's economic forecast isn't quite as bleak as the OECD's. The Federal Reserve is looking at about a 6.5% contraction, and you can see how the OECD is looking at 7.3. And then for next year, what kind of bounce back should we expect? The OECD says 4.1, and the Federal Reserve is at 5%. And so maybe this is kind of interesting, just the pace of this. So even when you look at the Fed's forecasts, they still are looking at nearly 10% unemployment at the end of this year. And they don't think the economy regains its previous height for 2 years. And so we've been hit. I mean, this is just to illustrate really how powerful of a hit we've had. And maybe to just drive home that point, we're not quite done with the second quarter yet. And some of the different Federal Reserves, like the Atlanta Fed and the St. Louis Fed and the New York Fed, come up with forecasts. They really have a GDP tracker. And the GDP tracker just sort of takes the data and sort of like an accounting function rather than a forecasting function. And the Atlanta Fed just updated theirs today, and they see about a 48% contraction in the economy in the current quarter. 48%. I think the other Federal Reserves and the market is something closer to 35%. But this is still going to be the worst quarter in American history. And if you remember, these are annualized rates. This is just a complete like shutdown of the economy. And I think that the good news is that we are probably through the worst of it, really assuming that we don't go for a nationwide shutdown again. So maybe the next slide sort of could help illustrate. So that we've had this big economic shock. And the U.S., by the way, if you looked at those numbers, the U.S. is not going to be hit as hard, and the recovery looks like it's going to be stronger. And part of the reason for this is the kind of policy response. Now, not to get involved in politics, looking at the Congressional Budget Office, which is a nonpartisan or bipartisan group, they're anticipating that the U.S. deficit this year, the budget deficit, is about 18% of GDP. Here on this chart, we had 15% of GDP. That's the spending that they're doing this year, 18% because we had a 3% budget deficit coming into this year. So on top of that, so 18%, and that is before there's a new bill that Congress is going to be debating next month. Because remember those $600 a month, $600 a week extra unemployment insurance payments, they are set to expire at the end of next month. And I think that there's a great push, especially in this election year, to avoid some kind of fiscal cliff. And I think we're going to see another package. Now, the House of Representatives passed a $3 trillion package. I think that's really more of a negotiating position. And I know the White House and the Senate are talking about a $1 trillion package. And the important point here would be that there's more fiscal stimulus coming. And what the Federal Reserve told us earlier this week, like I mentioned, interest rates will stay low for a long period of time. So if there's 17 people on the Federal Reserve, and 15 of them anticipate no rate hike through at least the end of 2022. So that's going to be, so I think we can account as businesses and investors that interest rates stay low. And of course, this is going to hurt people who are living on fixed income. But this table here, which is part of the package that you'll be able to get a copy of, this PDF, that it just goes through the different countries. And there's a couple of kind of ironic things here. One is the Abe government here in Japan. Their combined packages, they say, is worth 42% of GDP. It's not really, because what they have this concept, if they haven't spent money from a previous budget, or they've earmarked, they just keep rolling into the next one. So the next one becomes bigger and bigger because it's including things that aren't, excuse me, if we could just go back to that other slide. It includes other things that they've already assumed. But you can just, as you eyeball this chart and read the chart, you'll see that the governments are spending a lot of money, and central banks are printing a lot of money, cutting interest rates. And next week, I just point out a couple of things for you. The ECB, we put it under Germany, partly because the ECB is headquartered in Germany. But what they're going to do next week, the ECB is going to do, just to give you an idea about how much liquidity and how much stimulus is being provided. The European Central Bank is going to be providing 3-year loans to European banks at an interest rate minus 100 basis points. It's still mind-boggling. I think when we spoke in January, I was still trying to get my head around what these negative interest rates mean. And if you go to the next slide here, I think it'll illustrate, I'm sorry, maybe the one after this one. Oh, one more. Here we go. This chart shows you the value of all the negative yielding bonds in the world. And when I took this a couple of days ago, it was $11.2 trillion of negative yielding bonds. And so that's another way that countries have responded to the crisis, is issuing more bonds. And Europe and Japan are the primary centers for these negative yielding bonds. Just imagine that $11 trillion. So what we have in the United States today is our 10-year bond is at about 65 basis points. It sounds very low, and it's the lowest like in a generation. But it is higher than many other financial centers in Europe and in Asia. Maybe we could go back to that other slide, trade. Yep, there you go, that one, that's great. That shows, I wanted to illustrate this because as the economies have slowed down, and of course it's not just the US economy, it has really impacted trade. And so I can imagine it makes it harder for you at the World Trade Center when trade is just like shut down. You can see what some of these look like, the sharp drop in both imports and exports. And there's also travel, of course. And So you have this big shutdown in the economies, and it's reflected then as well in trade. And I think that for many of us, the question is, how soon can it come back on? And I think that we're beginning to see some pickup in air travel, and that's going to help. And we've seen a more demand from the Chinese after sort of balking earlier this year. They've been stepping up the U.S. has been stepping up the shipments of soybeans, which is also very important for trade purposes. Go to the next slide here. One of the drivers, just to illustrate what's going on then, is that these countries in Japan and Europe have low interest rates. And that's what this chart really shows you, is the U.S. premium on 2-year money of the different countries. Beginning with, you've got Canada, you've got Europe, you've got Japan in here, and you've got the UK. And you can see the point of this really is that interest rates are converging at very low levels. And this is just, and this is going to be part of our dollar story, because when interest rates in the U.S. are rising compared to other countries, when that premium, when that line is headed up toward the top of the page, that is the U.S. premium is rising. And that brings in a lot of the world's savings into the United States, because you think about it as someone who's trying to save money in Japan or in Switzerland, and you give your money you want a risk-free investment, you give the money to the government, and the government charges you for the privilege of taking your money. So as these interest rates converge, I'm going to suggest to you that the dollar is going to begin falling, and that's going to be a good thing for U.S. exporters who are struggling now with sort of closed markets overseas and a strong dollar. Those markets will slowly open up, and I think the dollar will begin falling. We're going to see the next chart here. I'm sorry, the one after this one. This is their negative yielding bonds. So this is a chart. I wanted to show you some currencies that matter to you. Among our biggest trading partners is the Eurozone. That's those countries in Europe that share a common currency. And so you can see how we've been in, this is a 3-year chart basically, and you can see how most recently we've had some volatility, which of course is the sort of the bane of trying to hedge and trying to protect your businesses. But what we've seen, as well as as this euro, as the chart moves higher, this is the euro gaining ground on the dollar. Back in March 23rd, when the U.S. stock market bottomed, so did the euro. And the euro has been climbing, and even though we've seen some volatility in the stock market in recent days, the euro still looks fairly well bid. And I suspect that we're going to finish the year. So on this chart, we were looking at something about 111.5 or so, 112. And I think that we are on our way to 115 this year, and maybe even 120. We can show you the next chart. This is another one of our biggest trading partners, Canada. And so here you could see during the crisis, this is a shorter term chart. This is only a 6-month chart, but just to illustrate, during the crisis, how we saw the dollar surge against the Canadian dollar. I generally find that Canadian dollar is one of the most important currencies for U.S. businesses, because so much of our trade, so much of Canada's trade is with the United States. As the Canadian, it seems to me that I would highlight 3 drivers of the Canadian dollar. Ironically, it's one of the most sensitive currencies to the U.S. stock market. And that's because many investors can be indifferent to whether they hold Canadian dollars or U.S. dollars. And when people feel the animal spirits, as they're called, when they get stronger, when people want to take more risk, tends to be that the Canadian dollar strengthens, the U.S. dollar weakens, partly because Canada offers a higher interest rate than the United States. So the first driver is general risk appetite. So I'd say you tell me the direction of the U.S. stock market, and I'll have a good idea, not a perfect idea by any means, but a good idea of the direction of the Canadian dollar. The second driver for Canada is commodity prices broadly. When you look at what they export a lot of commodities. I usually just simplify it, sort of, the KISS method, keep it simple, stupid. And I just simplify it by looking at one commodity, oil prices. And it's complicated because Canada imports expensive Brent oil from Europe. And on the other hand, it exports cheaper stuff to the US. And so it's not simply an oil play, but typically when oil prices are going up, the Canadian dollar tends to have, like I say, a wind to its back. And the third driver, as I mentioned, is really the interest rate differential. If you're indifferent, which one pays you more? And these days, the US offers less interest rate than Canada. I'll show you the next slide. And so this is, I think I showed you this in January. This is a interesting slide because this is how the Federal Reserve and policymakers think about the dollar. They don't really care about it so much on a bilateral basis. That's more for the politicians. What they care about is a basket, what it looks like against a basket of our trading partners. And we don't want to be confused with inflation. And so this is a real, meaning adjusted for inflation, broad, meaning it includes all of our trading partners, trade-weighted image of the dollar. And as I talked to you before, we had the first big rally was the Reagan dollar rally. And then we had the Clinton dollar rally, the Bill Clinton dollar rally. And then we're having now, or in the middle of, what I think is the Obama-Trump dollar rally. And I thought this rally was just about over. And I thought it was looking good for my arguments until the COVID crisis hit. And that's when we had this other spike up, as you can see at the very end. I'm maybe stubborn, maybe it's that Cubs fan in me, reluctant to acknowledge when the season's over. But I do think that the dollar is turning still, and that this crisis sort of bought it some extra time. So I'm still looking for the US dollar to weaken, partly as things normalize. I think that a lot of asset managers are underweight Europe. And I think that the twin deficit problem, which in the US, the twin deficits, large budget deficit and a large trade deficit, I think that'll begin weighing on the US later this year, early next year, as the economies generally stabilize. Maybe one more chart here for you. And I'm really happy to present this one. We haven't, at Bannockburn, we haven't like officially launched it yet, but I wanted to share it with you, partly just as a sister city to my Chicago background. I thought to share with you in St. Louis. We have not, most of these indexes, like I just showed you, the trade-weighted index, this is the general approach. You trade-weight a country's currency and you look at it. And I kind of think that in this day and age in which globalization is being threatened, that I thought that it'd be helpful to begin thinking about the global economy still. And so this currency basket is not trade weighted, but is GDP weighted. It includes the top 12 economies in the world, and I count the Eurozone as one, even though they're not really united yet. Perhaps one day they will be. Top 12 economies weighted by GDP. So roughly speaking, the US, the Eurozone, and the Chinese are roughly the same weighting. Each one are about 20%, give or take a little bit. But the top 12 economies in the world, half of them are emerging markets, or what investors call emerging markets. It's hard to imagine that, right? South Korea has a per capita, like let's say their standard of living, is higher than some countries in Eastern, Central, Southern Europe, like Spain or Italy or Greece. And so it's kind of ironic that they still consider those emerging markets, but we go with the World Bank's definition of emerging markets and their measures of GDP. And this index, we haven't launched it yet, but I think that it's what's interesting is that it does track things like the JP Morgan emerging market currency. It tracks as well very nicely a basket of international stocks, even though those stock indexes are weighted by market capitalization. It comes very close to approximating GDP. So I leave you with this couple of ideas before we turn to the future. Let me just sum up those ideas for you. First, as you know, and as you probably experienced already, the U.S. economy, alongside the world economy, has been hit with a heavy blow, unforeseen by the COVID pandemic. Economies have shut down. The good news is they're beginning to open, and it looks like the worst is past. And I think that the next week, as you look at the news, I think we'll see a couple of reports that will help lend some credibility to this argument. Next week, we're going to get the May retail sales, May industrial production numbers. Those are likely to be very strong up numbers only because we've fallen so far. But we're looking at retail sales, industrial production showing strong gains, and same thing with housing starts and housing permits, building permits. This is just part of the evidence that the economy is beginning to open up. And then next week, we also get the first sort of soft data, survey data for the month of June. And that's going to come from the New York Fed, Empire State Survey, and the Philadelphia Fed. They do these manufacturing surveys for the month of June. And that would show the second month in a row of gains. So I think that there's some reason to be a bit optimistic on the economy, that the worst may be past with the second quarter. Economy beginning to open up late here in the second quarter. We should look for a much better second half than a first half. And as things normalize, I think the dollar's big cycle will resume, and that I think points to a weaker dollar, which is good for especially small and medium-sized businesses who are involved in trade and especially exporting. The challenge, I think, the large businesses have a lot of I should say various tools that you can have access to for bigger. It sort of works better on scale. I think that businesses who are thinking about the foreign exchange market should think really about three issues, three questions you can ask yourself. One is, what are my exposures? And I talk to some businesses, including in the St. Louis area, who think that they sell their product to another country, but they get dollars, and that they don't have a currency risk. But what happens is they get dollars, but their producer or their customer has to get local currency. And if there's a big shift, that can affect the demand for your good, even though you just have dollar exposure. So first question is, what are your exposures? Secondly, this is the hardest one, is what are you paying for it? You know, when I buy a stock, I get this statement from my broker that says, you bought this stock, it tells me the price, it tells me the taxes, it tells me the other fees. The foreign exchange market is much more opaque. It's hard to see those things. It's not very transparent. So you want to see what you're really paying. And as a service to the World Trade Center members, we offer a free review of the prices and compare the prices that your bank is charging you with what the market was actually at. Just give you a better idea of what those costs were. And the third issue really then sort of follows from that is, if you know your exposures, you know how you're managing them, you know what they're costing you, can you make it more efficient? And that comes down for you, that really gets paid for you on the bottom line then, any savings in foreign exchange. So now, before I wrap up, let me just suggest some things about how I'm thinking about what the future would look like. And the first thing I think that we should be aware of is this growing animosity, growing tension between the U.S. and China. And that's important because, you know, there's this economist, Niles Ferguson, who did those PBS specials about money, and he came up with this name called Chimerica to really illustrate how the U.S. and China were like the two pillars that held up the sky. And now it seems to me that I don't think that was ever really fair. I think it was kind of naive kind of view. But what's happening though is that there's clearly a divorce coming, and I think we are in the early stages of a Cold War with China. And by Cold War, I don't mean we go have a hot war. I mean that that the tension between the U.S. and China is a fault line that affects all the international institutions. It affects a wide spectrum of businesses as well. So think about what's going to happen, I think, as this Cold War takes place. I think I mentioned this to you in January, which is ironic because I hadn't been thinking about about a virus or anything. But at the time, I just got done reading a book called China RX. And it talked about how something like 95% of the U.S. penicillin, that antibiotic, we get from China. And I knew at the time, this is not good, this cannot be sustained. And I think we're not just seeing it in the United States, but Europe feels the same way. So does Japan. And so we're going to see, I think, as part of this Cold War tension between the U.S. and China, we're going to see companies sort of readjusting their supply chains. The tariffs were a push in that direction. I think this COVID experience and the tension between the U.S. and China forces more of those businesses to look for alternative sourcing, closer, less complicated supply chains, And that often means now that we have the new US, Mexico, Canada free trade agreement, we've protected the flanks. That is, we still have this continental market. And so I would expect to see, especially on the manufacturing, to come back to the US. And the challenge here is manufacturing is not so much labor intensive the way it was 20, 30 years ago. It's becoming increasingly capital intensive. Less workers, more machines. But that manufacturing adds to the US GDP, and I do think there'll be opportunities for businesses as that becomes sort of re-onshore or re-nearshore, if you will. But that economic nationalism is another part of what's going on. It's not just about medical supplies and devices. Many countries have, including the United States, have tightened up rules about foreign direct investment. That is, for foreign businesses to buy a company or to set up plants and production. Another sense of the economic nationalism. And what this leads to, you know, when you think about what's going on with the corporate bailouts and the government taking an equity stake, and again, it's not just in the United States, this is around the major industrialized countries. We're really talking about the downside would be like a state capitalism, where the state obviously plays a bigger role through the Federal Reserve and the capital markets, including recently the Federal Reserve has begun buying some ETFs, bond ETFs, these exchange traded funds, a basket of corporate bonds. Some of them are below investment grade, and some of them I think have included Hertz, the car rental business that's having some problems. But that's what worries me. I think our concern is that this Cold War with China leads to more production coming to the US, which is a good thing. But the economic nationalism is going to see trade decline. Things that we used to be ordering or buying from overseas, we're going to try to do more of it ourselves. In fact, I think the Make America Great Again and the Made in China 2025 are just opposite sides of the same coin. And that coin is import substitution. Think about it from China's point of view too. China is beholden to two mobile operating systems, both here in the US. OIS for the Apple and Android for the others. And it's just, it makes no sense that China stays dependent on them. They're going to find their own, which means for businesses or for even tourists going to China, you're going to need their cell phone, their apps to access things like taxis, groceries. Increasingly, it'll be done through the internet and through different apps. So it's back to the days like earlier in our careers where we needed when we visited Japan, we needed 2 phones because the Japanese phone system operated on a different basis. That World Wide Web, I think, is going to become fragmented, like a fork, if you will, like Bitcoins. And the other thing I'd leave with you about the future is, you know, a lot of people, I think, we're speculating about what kind of bottom is going to be. Is it going to look like a V-shaped bottom, which I think most people now discount? Maybe it's a U-shaped bottom. It takes a little bit longer to turn. Federal Reserve Chairman Powell talked about why a W-shaped bottom wasn't very likely. I've been thinking about this, and what strikes me, the letter that strikes me is a K. And K doesn't really sound like a bottom, but it's really to illustrate the likely divergence. And one of the new words I think that we all became more familiar with in through this COVID is pre-existing conditions. And I think it's those pre-existing conditions that determine whether one will come out of this crisis better off. And some countries probably will, at least maintain their strength or sort of a growing divergence. And so I think Germany, for example, in Europe, because it was in a fiscally austere position before, running a budget surplus, it's got that fiscal room to spend a lot of money for the recovery. Unlike a country like Italy or Spain or Greece. Same thing with the United States. When you think about the size of our deficit that we're going to run and what it does to our debt, it's sort of like, it's intimidating. But very few countries have that. And just like after the 08-09 crisis, where the US, so the old FIFO rules, right? First in, first out. The US responded aggressively, came out earlier, was able to begin normalizing policy long before other countries. And so the danger is, because countries went into this crisis with different pre-existing conditions, they will emerge quite differently. And there's going to be new divergence among, so those who have will be given, so to speak. So, well, thank you very much for your time. I hope this was an overview that you could appreciate, and that happy to begin talking to our guests, to people who have questions here. And just on this last slide here, this is just my local contact from my local partner, Chris Haynes. And there's his phone number and my contact data as well. And on the next slide is just, if you like to think about these macro issues and you don't get enough from the news, my blog there at the bottom, Marc to Market, and Bannockburn is on Twitter and LinkedIn, and so am I. So please feel free to reach out. Thank you.
Thank you so much, Marc, and a great presentation. In particular, those practical tips that companies can take to do something now. So thank you for that. We do have a few questions, so we'll get started. And again, just a reminder: if you wish to pose a question, please do so via the Q&A. So our first question here. Marc, you shared that the US invested 18% of GDP in COVID stimulus. Aside from Japan, that appeared to be the most, was it enough? Too much? Could we have approached this differently or better?
Yeah, that's a very good question. It's always it's sort of, I think, one of these things where if you spend a lot of money and nothing happens, people think you overspent. And if you don't spend enough money and something bad happens, you obviously underspent. So I don't know if there's a right. I think we're sort of like besides those blind men looking for that elephant. Sometimes I think we're like blind men looking for a black cat in a dark room. You know, that we have to really feel our way for this. And I think that the Federal Reserve has shown some great flexibility. You know, and this is why I think that the government itself, the federal government, why it rolls out these programs sort of piecemeal. So they can try to calibrate get the right measure. And I don't think we ever get the right measure. But again, what concerns me, though, with these programs is that it could lead to greater divergence rather than greater harmony. I think that Chairman Powell at his press conference on Wednesday was really talking about this. It was very, I don't remember the last time a Federal Reserve, the head of a U.S. central bank, let alone any central bank, spent so much time talking about the people who he cannot help through monetary policy and the lending money to businesses and banks. I think that what's different this time is never before have we really made these cash payments in such size. And there might even be another round of those payments. And that's not only the United States, but other countries have done the same thing. And unlike in 08 and 09, there's a greater effort to help the small businesses through the Federal Reserve buying SBA loans and and really acted aggressively to preserve those capital. And I think the real challenge, I think the real measure of answering your question is really if the Federal Reserve thinks it's doing is a bridge between solvency, and it knows that solvency and liquidity. It knows that if we can treat the problem like liquidity for a short period of time, that can act like a bridge to help sort of avoid or stretch out the solvency issue. So I think between the liquidity and solvency, I think that's where the problem lies. And could we have done something differently? I think that as push comes to shove, I think that for example, if we have another big second wave, I think we'll see greater innovation as well, more cash payments to the people who really need it.
Great, thank you for that. And another one. There are many St. Louis businesses invested in China, not just supply chain relationships. With a pending economic Cold War, what advice would you have for them?
Yeah, this is a very tricky situation. You saw what happened with, I think it was Standard Chartered and HSBC, who obviously have big presences in Hong Kong. And they took China's side in this big debate, I guess, over these new security laws that China is imposing on Hong Kong. I visited China. I think it's a country that's really on the move. But I think that what you want to think about what we think about investment is a diversified portfolio, and I think we might have to think about that with supply chains, and that is production or customers or whatever we're doing there. Can we find? Can we have redundancies? Are there other markets in Asia we could grow into for our clients? The fascinating country I think right now is India, because India last year jumped 2 places in that league table of the largest economies and is now bigger than France and the UK. So I think that if tensions continue to increase with the US, I could see how some businesses like Apple, for example, says that, or GM as well, you know, China is a bigger market for GM cars. That is to say, Chinese buy more GM cars than we do in the United States. So it makes sense that GM stays there. It's a very large market. You leave there and you give that access up. So I know it's a delicate thing, and I think you just have to weigh it by company, industry by industry, to see what makes sense. But to be aware that it probably, the base in China, what you're doing in China, probably can't leave China. That is, it's very difficult to take profits out of China still. And the tariffs with the US, and not just with the US. You know, the Japanese, they had that big budget. I suggest they have some of it's double counting. But the Japanese are beginning to pay companies to relocate from China to Japan. India has put some generous terms of new land for businesses that move back from China. So I think that you'll see, as these tensions rise, harder and harder to use China as an export platform or an import, and rather just produce there for that large, incredibly large domestic market.
Great, thank you. And I can say here at the World Trade Center, we've noticed the importance of India as well, particularly actually with our Mosaic project, who are trying to attract more Indian immigrants to the region. So India is definitely one to watch. Let's check for another question here. Do you see any longer term impact in the US of the civil protests of recent days?
You know, it's really interesting. We were just talking about it sort of over our family dinner, because you know, we had so many of these school shootings, and we say, well, this is going to be the last one, and sadly, there seems to be like another one, right? And I wonder if it's the same thing with this. I did my master's thesis at Northern Illinois University. It's a state school in like the northwest tip of Illinois, and I did my master's thesis on Frederick Douglass. So he's a slave that escapes to the north and then tries to fight slavery, which is it's like backed by the Constitution. And so I think that is there going to be more racial equality in the U.S.? I think we all can hope so, but I think that the struggle is still in the early days. You know, I worked at a bank when that football player would take a knee during the national anthem, and the kind of grief that he got. I still don't think he's playing professional football. And so I think that the latest polls I've seen, though, suggest that there has been a change in like the America's social psyche about this, just like we've done before. I mean, a couple of years before women got the right to vote, it never would happen. Before 18-year-olds got the right to vote, it wouldn't happen. Before we passed the Civil Rights Act in the early 60s, it was never going to happen. So I think we do have some of these turning points, and these turning points typically come around crises. And I think this COVID crisis was a major one. And so I am hoping that we get a greater social equality from this. I just, in my experience and things that I've read, I just think it takes a sustained struggle to achieve it.
Thank you, Mark. I think we're all of that mindset that we certainly are hopeful for change this time around. One other question, this is a long one. What impacts pertaining to the price of commodities do you expect now and within the next year pertaining to China and its reduction or possible ban on importing rare earth metals?
A very good question. You know, these rare earths are another one of these incredible things, because the U.S. used to be self-sufficient. And my green friends would say that mining this stuff proved like horrible for the environment. And so partly because of regulation and partly because of how China competes, China now is the world's biggest provider. And that can't be sustained. I mean, you think about like our way of life, if I could be such a broad term, but like from our computers, our cell phones, military things like radar, rare earths. I have a car that has about 35 pounds of rare earths in it. And so we need rare earths. And the problem, I think, is China has this trump card, and it's used it before, especially when it had some sort of disagreements with Japan. It tried to cut Japan off of these rare earths as well. So I do think it's a point that China can have, but it can only be played once, and only be played if the U.S. Doesn't do anything else about it. And I think you're seeing some movement. I think that people in Washington recognize the importance of those rare earths and are trying to find alternative sources. And it's not just getting those rare earths, but it's also processing them. And we really don't have that capacity yet. But that's another one of these opportunities when I talked about the import substitution and the reshoring activities. Rare earths, so essential in a modern manufacturing. I do think that we're going to do more of it here, and we just got to find a cleaner way to do it.
Oh, my apologies. I think I was on mute there. Just a reminder that if you do have a question, please do so via the Q&A. We're still taking questions. I did have a question for you, Marc, with regard to the WTO and the institutions that you mentioned earlier. Where do you see their role? How do you see that evolving, in light in particular with the resignation of their executive director recently? There seem to be a lot of issues there. Where do you see that a role for that organization going forward?
Yeah, isn't that tough? I mean, because I used to think about GATT, the predecessor of the WTO, and that GATT, G-A-T-T, was a general agreement to talk and talk. Multi-year rounds of trade negotiations to reduce trade barriers. So that's been superseded by the World Trade Organization, and there's been a couple of rounds, but the problem is now I think is that there's no political, two things. One is there's no political will for one of these broad agreements, partly because of the US attitude about bilateral, but partly in general, the last round really wasn't even completed yet, the Doha round. And so one function would be to get these large trade agreements, and the other function of the WTO is sort of conflict resolution. And the conflict resolution channel has also broken down, and here it's really the US really blocking the appointment of like appellate judges, if you will. And so a couple of things will happen. One is sort of the WTO was weak and it's been sort of defamed further. That is, no big global trade agreements, no very weak adjudication process. So I think organization's weak and it's going to need to be reanimated. That is, got to be life brought back into it, and that's going to we have to see what happens after November. I think if President Trump gets reelected, I think that we can count the WTO out of those two functions for quite a while. I think that there'll be bilateral agreements and regional trade agreements, and they could bypass the WTO. So in the big picture, what it could lead to is a balkanization, or so like how my wife quilts by putting several patches of things together. So we have a couple of regional trade blocks, and then you can have, you marry those regional trade blocks. But I am concerned about the direction of trade. I think that, I think that there are things that trade does for us as a people, besides just getting cheaper things. Oftentimes in countries, how people are on the coasts, much different than the interior. And even though I grew up in Chicago, you're there in St. Louis, and even though it's landlocked, I think that partly because of the internet and partly because of the Mississippi River, places like Chicago and places like St. Louis aren't really simply landlocked. Having access to trade is a very important thing. And I think that it makes us all better. And we learn different things by seeing how other people, people say there's one way to skin a cat. There's always another way to skin a cat. And seeing how other people do it, I think we can learn best practices. And I'm afraid that the trade is going to be really a challenged issue for some time, not just because of the US, but again, China, Europe, there's people are becoming more reluctant, don't see the advantages of trade as much as they did previously.
Okay, let's see if we have, yes, so one other question. Any thoughts on Brazil and the possibility of deflation?
Brazil, it's an amazing country, huh? I mean, I think that, I'll tell you a quick story, is when I was younger, I was applying for a master's in international relations. And there's only a couple places that had what was called political economy, international political economy. And the Woodrow Wilson School at Princeton was one of them. And they required a policy analysis. And so I wrote one on why Brazil should declare a unilateral moratorium on their debt. And I don't know whether it was the essay was poorly written or the argument was poorly thought out, But in either way, I never got accepted to Princeton. But I follow Brazil because it's a huge country, and I like it environmentally. It has the most amount of fresh water in the world. However, Brazil, the sort of contrast is between Brazil, who has elected a state nationalist, and Mexico, that's elected sort of a left nationalist. And during the crisis, both of those currencies collapsed. And even now, South America makes up, or I should say Latin America makes up about 8% of the world's population. And it's making up right now about 40% of the new COVID cases. But both in Mexico and Brazil, the countries are not really taking an aggressive response, either through like public health issues or through monetary and fiscal means. Having said that, Brazil is going to cut their rates again, likely next week, maybe 50 to 75 basis points. Their interest rate is still above the rate of inflation, and inflation is falling, but this is a short-run problem that we see, right, with oil prices. Remember when oil prices in April dipped into negative territory briefly. And so I don't think that Brazil's biggest problem is going to be deflation, but it is going to be a very weak growth, and I think that we still haven't seen this peak in the pandemic. And same thing in Mexico. The government's response is relatively weak, and I think by both countries have seen their currencies surge is really what's driving all the capital markets, stock markets, emerging markets, these kind of high risk currencies. What's driving them is that the central banks and governments have basically like opened up the taps and have let a lot of liquidity in, and this liquidity is like rising all boats. Even some boats that have holes in the bottom get risen or lifted by this flood of liquidity. And I think it's going to take some time for the markets to become more discerning about which emerging markets are really strongly positioned. And I think that we're going to have to review Brazil and Mexico. I think that both those currencies are going to become more of a problem for those countries than helping them as they try to get back on their feet.
Okay, and I think we have time for maybe one last question. And Bomi just mentioned to me, she said this is a loaded one. What impact will Brexit have on future trades?
Brexit. I thought, how could I pass up, like, with your accent, how could we not talk about Brexit at least a little bit?
And that didn't even come from me.
So Brexit, so here's where we are. Is the UK has already voted to leave the EU. Legally, they've left the EU. And this year, then, is this transition period, a standstill transition period, while they negotiate a new trade agreement with the EU. But both sides are being very stubborn. And here we are halfway through the period, and they're still like miles apart. So we'll see maybe the politicians later this month, both Prime Minister Johnson from the UK and the EU head, maybe meet and try to sort of reinvigorate the talks through politically getting involved. But it's possible that there's no agreement at the end of this year, which would be very disruptive to not only to the UK, but also to the EU. And in the UK, people who, as I mentioned, some countries have negative interest rates. Some people are betting that the UK could get negative interest rates if they leave the EU without a trade agreement, which would mean they would fall back on the WTO standards as they are, but it'd be very disruptive to the UK economy. And they think that is when the UK, when the Bank of England would adopt negative interest rates. But at the same time, the US and the UK are involved in trade negotiations, as when the UK is part of the EU, they can't have other trade agreements that the EU doesn't have. The EU is the negotiator. Well, now the UK is not only talking to the US about a trade agreement, but they also are in advanced talks with Japan about a trade agreement. And so I do think that we'll see the UK having lots of different trade agreements. At the end of the day, though, the UK economy is really too small to have much impact on the US economy. And so I'm afraid that we might not get as much out of it, except as far as just promoting another bilateral trade agreement, which is what President Trump wants, bilateral agreements. And the other point about it is with the US, it could be an executive agreement, which means it would not need congressional approval, but it also means that the next president could renegotiate it.
Okay, Marc, thank you so much. I think we've covered everything from Brazil to Brexit to China. So you've given us certainly a lot of food for thought, and always good to take a peek inside your crystal ball. Thank you so much. So I just want to thank everyone for joining us. We're almost at the top of the hour. Thank you again for taking some time out on your Friday afternoon to join us today. We will have another session in July. The date and details are still being worked out, but check your inboxes. You will receive an invitation to our next session in July, and of course it will also be on social. So with that, I'll pass the final word back to Tim, and thank you again.
Yeah, thanks, Stella. And Marc, thank you again for your always informative, optimistic comments, but always with a heavy dose of reality. You know, just to bookend things really quick, I mentioned the Chicago Cubs and the Cardinals on the front end. As luck would have it, we were supposed to be in London at this very moment. The Cards and the Cubs were supposed to be playing a 2-game series this past weekend, and the World Trade Center was leading a industry trade and investment mission to London to be a part of that, and also to meet with potential business partners. And unfortunately, but for all the right reasons, we're not there. We're here, but we certainly, with your comments and with where we hope things head in the future, we look forward to re-engaging with our international partners and re-engaging in trade. And I'm sure we're going to get there at some point. So again, thank you for your remarks. Thanks to everybody who joined us here today, and stay tuned for the next session of Re-engage in Trade.
Thank you.